Jobs are growing, inflation is still above 3%, and the Fed is keeping their interest rates the same. Let's quickly talk about each of these developments and review again how the economy is sending mixed signals. Last Friday, the Bureau of Labor Statistics released their employment situation for the month of May. The two main pieces of information from it are that non-farm payroll employment grew by over 270,000 jobs, and the unemployment rate came in at 4%. This is a continuation of a really hot job market, at least on the surface, in which we've maintained low unemployment over a historically long period of time, coupled with payrolls that have been growing consistently over the last several years. These added jobs are mostly coming from healthcare at 68,000 adds, government at 43,000, and leisure and hospitality at 42,000. The other notable sectors were professional, scientific, and technical services, social assistance, and retail. Where jobs have stagnated over the month was in sectors like raw resource extraction, construction, manufacturing, transportation and warehousing, and interestingly, financial services. Now, one argument I hear quite a bit these days is the job market may be adding jobs every month, but what is the quality of those positions? What if they're all part-time jobs with limited compensation and less security? Well, let's take a look. There are currently about 26.7 million part-time workers right now. And of those workers, 4.4 million of them are working part-time for economic reasons, meaning they could only find a part-time position or their hours had to be reduced. That's about 20% of all part-time workers. So the other 80% are part-time by choice. And that's probably due to the rise of the gig economy and the flexible opportunities there. In fact, we actually saw a 50,000 job reduction in part-time workers for economic reasons and a 400,000 job add to part-time workers by choice. So yes, part-time work is on the rise, but it doesn't appear to be because that's all that's out there. And one other note on the quality of the job market. For about a year now, wage growth has actually outpaced inflation. So employees continue to be compensated at levels that exceed changes in the cost of their living. So in terms of the job market, I do think the most recent data suggests it's still going strong. It continues to prove its resiliency in the face of higher interest rate policy, at least at the national level. Positive economic signal. Inflation measured by CPI came in at 3.3% year over year for May. And removing food and energy gives you core inflation at 3.4%. Although this technically beat expectations, it wasn't by much, and really it's just a continuation of the trend that we've seen for the first half of the year. Remember that CPI is a weighted average of several different categories, so it's always helpful to look at those and see why you may be feeling inflation more or less. Some things that pop out to me are transportation services as an outlier at 10.5%. Food away from home rose 4%. The cost of shelter just doesn't want to go down. That's at 5.4%. And the largest decline was seen in used cars and trucks, which makes sense. The car market is the one place where interest rates are having an effect. So even though overall inflation is around 3%, your individual situation determines which of these subcategories of goods and services will impact you the most. For instance, if you're a family of, say, 4 that is looking to either purchase or rent a home, and you typically eat out due to your busy schedules, you really felt the pressure this month, relatively speaking. As I've said in past videos, my main concern around inflation is the possibility that we've entered a period where inflation stagnates above the Fed's 2% target, basically saying that inflation is no longer responding to where the Fed currently holds interest rates, ultimately forcing them to actually raise rates. Let's talk about that next. The Fed made the decision to keep the federal funds rate where it is, a range between 5.25% and 5.5%. Their reasoning for pushing a rate cut further down the road was that the most recent inflation data was not enough to justify a pivot in their policy. They want to see multiple instances in which inflation comes in lower than expectations and works towards that 2% target. The risk of cutting rates too early would be reintroducing a rising inflation rate, undoing the progress we've made, and prolonging the period of people still facing the higher prices and higher rates. The Fed knows this, and that's why they're 100% committed to their 2% target, barring any economic catastrophe. If you think about it from their perspective, how are they looking at two conflicting signals? A positive jobs report, but a less than adequate CPI rate. Recall that the Fed has a dual mandate as an institution: price stability and maximum employment. What they see is inflation that needs to come down some more, but a job market that has some room to cool off without massive repercussions. Hence the decision to keep rates high. Based on surveys that we've seen, the number one economic concern of the American people is inflation. The high cost of living, the cost of food, the cost of services, the cost of childcare, the cost of everything. Concerns around interest rates are there, especially for those looking to buy a home or a vehicle, but they have yet to even come close to the impact of higher prices. Fighting inflation is priority number one. Now, of course, there's always the prospect of a soft landing, in which the Fed successfully defeats inflation without disrupting the economy. And that could explain some of the mixed signals. But then, that opens up the discussion to whether or not you think the current state of the economy is as strong as they say. And that's where I'll end this video. More jobs, high prices, and high interest rates. What do you think about all this? Are we headed in the right direction? Are we facing stagflation? Is the data missing what people are actually dealing with? Let me know. I'd love to hear y'all's opinion. If you enjoyed the video, consider liking and subscribing for more. But for any questions, you can leave those in the comments or reach me at askalexherrera@gmail.com. As always, thanks for watching. Until next time, take care of yourself and best of luck.